Hello, Patrick Walchuk here to give you a financial analysis as we usually do every month. In this case here, it's a 5-unit building located in Centretown West that sold in the month of May. So let's take a look at the numbers and do a little interpretation of them. So this, again, 5-unit building, Fiveplex, it was listed for $1,020,000. It sold for $980,000. Now the scheduled rental income on it was, we'll call it $98,000. And the effective rental income after we deduct for vacancy and bad debt was $95,000. The stated operating expenses from the MLS listing were $24,000. And when you factor in maintenance and management, the total operating expenses would be $34,000, and that leaves us a net operating income of $61,000. Okay, what does that mean? And so we go to the very important cap rate, and the cap on this was 6.25, which is very, very high. You know, usually we're looking at something between 5.5 kind of thing is good. It sold, the operating expense ratio was average. 35 is, you know, in the good category. It sold for 10 times the gross, 16 times the net, which is on the low side. Now, what we always do is calculate what's the minimum down payment that you would have to put on this kind of property in order to have a positive cash flow. And we can only go as low as 20% because that's a CMHC requirement that for a non-owner occupied property that you need to have a 20% down payment. So that's the number we had to go with here. So 20% of the sold price was $196,000, and our monthly payment would be $4,000 and change. So the annual debt service, fancy way of saying the annual mortgage payments, are $52,000, and that leaves an owner with a positive cash flow of $9,000 and an ROI of 4.7%. Now this is very high, so you know that's no surprise based on a cap of that. So I'm not familiar with the property, I hadn't been in it, so there was probably some deferred maintenance issues on the building, and that's what it sold for. Thank you for watching.